Hey everyone, and welcome to The Explainer. Today is June 2nd, 2026, and man, we have some massive structural shifts hitting the crypto market right now. We're going to completely bypass the noise today and use the raw data to figure out exactly what is happening beneath the surface of the market. Let's get into it. Let's just jump right into the action. Bitcoin just decisively broke the 78,000 mark. And this isn't just your standard random volatility. This is a massive global relief rally sparked directly by geopolitical developments, specifically the reopening of the Strait of Hormuz. It's a classic case of real-world macro events immediately lighting a fire under digital assets. But to really get a feel for the gravity of what we're looking at today, we need to zoom out for a second. The global crypto market cap is sitting at an absolutely staggering $2.809 trillion. To put that into perspective, this asset class isn't just a niche anymore. It is literally ballooned into a macroeconomic pillar all on its own. And within that nearly $3 trillion universe, Bitcoin is still the undeniable anchor. You can see it holding a massive 58.3% dominance over the entire landscape, leaving the other 41.7% to the altcoins. So, whenever we're talking about industry-wide shifts like we are today, we always have to remember that Bitcoin's gravitational pull is still commanding the room. Okay, let's dive into this. Here is our roadmap for today. Number 1, market check, tactical realignment. Number 2, macro forces, Fed and legislation. 3, the ideological lobbying divide. 4, mining, survival of the fittest. 5, the decentralized market shift. And 6, the bottom line. We're going to connect those macro forces right down to the deep on-chain plumbing. All right, starting with section 1, market check, tactical realignment. So what does this actually mean? Well, we aren't just looking at red and green price action today. The market is officially entering this phase of technological and tactical realignment. Basically, we're seeing massive macroeconomic shifts violently colliding with the deep mechanics of the industry. The underlying plumbing of crypto is maturing rapidly, and participants are literally being forced to adapt their tactics if they want to survive. Moving right along to section 2, macro forces, Fed and legislation. Now, this is fascinating. Kraken just released a strategic report mapping out 3 potential paths for the market, especially with the potential confirmation of Kevin Warsh as the new Fed chair looming over us. They're looking at 3 scenarios: maintaining the status quo, a gradual easing, or an aggressive crypto-friendly policy. And believe me, the market is watching this like a hawk because a Warsh-led central bank is widely viewed as the primary catalyst that could finally yank Bitcoin entirely out of its current range-bound state. Meanwhile, over in Washington, regulatory friction is really challenging the market ceiling. Key U.S. lawmakers, specifically Senators Tillis and Alsobrooks, are reportedly finalizing draft language to resolve the long-standing yield fight embedded in the Clarity Act. This is absolutely huge. This new text could actually provide a fully regulated path for stablecoin interest. Think about that. If this passes, it has the potential to unlock billions, literally billions, in dormant capital for on-chain lending. Which brings us to section 3, the ideological lobbying divide. And this brilliantly illustrates the growing tension we're seeing at the top. On one side, you have Twitter founder Jack Dorsey publicly demanding clarity after claims that Coinbase's CPO opposes certain Bitcoin native tax relief measures. He wants specific focus. But juxtaposed against that, you have Coinbase CEO Brian Armstrong pushing a much broader, industry-wide crypto lobbying strategy. Strictly looking at this as neutral observers, it's clear this friction highlights a very real, growing ideological divide in how the industry's leadership thinks they should prioritize their legislative efforts in Washington. Let's pivot to the physical infrastructure in section 4, mining, survival of the fittest. Just as Bitcoin mining difficulty jumped up by 3.87%, which obviously squeezes miner profitability pretty hard, Bitdeer simultaneously comes out and announces a brand new mining efficiency record with their SealMiner A4 series. What we are witnessing right now is a literal survival of the fittest. These tightening margins are violently forcing a split in the industry. You have the miners who can scale with a quality growth hardware advantage, and then you have the ones getting filtered out of the game entirely because they're suddenly operating at a loss. And speaking of surviving and building institutional trust, check this out. The MEXC exchange just published its proof of reserves, revealing a mind-blowing Bitcoin reserve ratio of 295%. That is massive over-collateralization. Basically, centralized players are using this extreme cushion to aggressively bolster user trust. We are fully entering a brokerage-grade era, where having absolute on-chain transparency isn't just a nice-to-have anymore, it's a competitive necessity to keep your users. Next up, Section 5, the decentralized market shift. We are watching a critical structural shift play out in real time right now. Decentralized exchanges, or DEXs, now capture a record-breaking 20% of the global perpetuals market share. This is a massive takeaway. It tells us that even when Bitcoin price action is kind of muted, the actual revenue-generating plumbing of the industry is getting way more decentralized and resilient. Institutional and AI agentic volume is increasingly migrating away from centralized platforms because they want that on-chain derivative transparency. And this decentralization isn't just happening with trading volume, it's extending to governance itself. Balancer Labs just officially announced they are shutting down so the Balancer DAO can take full autonomous control of the protocol's future. I mean, wow. This is a true landmark moment for decentralized governance. It's going to be a huge test of the market's appetite for pure DAO structures that are explicitly designed to permanently eliminate centralized points of failure. All right, let's wrap all of this up with Section 6, the bottom line. So how do we connect all these micro-mechanics to our macro strategy? Here are your actionable takeaways. First, keep a very close eye on that $78,000 Bitcoin support line as the market digests all this geopolitical news. Second, closely monitor how the market reacts to Kraken's Fed scenarios, especially any news on Kevin Warsh. And lastly, anticipate some massive capital rotations. The highly efficient decentralized plumbing we just talked about is gearing up for a major month of growth. Which leaves us with this final provocative thought to ponder. If lawmakers Tillis and also Brooks actually get this stablecoin yield language through the Clarity Act, will those billions in dormant capital unlocks drive the next massive DeFi rotation into high-performance protocols like Aave and Balancer? It is definitely a fascinating structural shift to think about. Thank you so much for joining me on this explainer today. Keep your eyes on the data, and I'll catch you next time.